Trading psychology. Nobody warned you about. Most people think trading is about charts. They believe the real battle is understanding indicators, patterns, strategies, or market news. But that's not the real battle. The real battle is what happens inside your mind the moment money is at risk. Because trading has a strange way of exposing parts of your personality you didn't even know existed. Fear you didn't know you had. Greed you thought you could control. Impatience you didn't realize was costing you money. And the worst part is this: nobody really warns beginners about it. Most trading education focuses on what to trade. Very little focuses on how your mind behaves when real money is on the line. And that's exactly why many beginners blow their first account. Not because they couldn't learn the strategy, but because they couldn't control themselves. In this video on the trading Jagaban, we're going to talk about the trading psychology nobody warned you about. Not motivational quotes, not hype. Just the uncomfortable truths about how your mind behaves when you're trading. We'll break down 5 of the most dangerous psychological traps: fear, greed, overconfidence, impatience, revenge trading. We'll look at how they show up in real trading, why they destroy accounts, and how disciplined traders deal with them. Because if you don't understand these psychological traps, no strategy will save you. Part 1. Fear. Fear is usually the first psychological enemy every trader meets. It appears quietly, and most beginners don't even recognize it. Fear shows up in several ways during trading. You enter a trade, and the moment the market moves slightly against you, you panic and close it early, even though your strategy says the trade is still valid. Or you hesitate to enter a trade that perfectly matches your setup. You stare at the chart, you analyze it, you confirm everything, but when it's time to execute, you freeze. You start second guessing. You wait. And then the market moves exactly the way you expected, without you. Another form of fear shows up when traders reduce their position size so much that the trade becomes meaningless. Or they move their stop loss too quickly because they're afraid of losing. These behaviors don't feel like fear, they feel like being careful. But in reality, fear is quietly controlling your decisions. Now here's why fear destroys trading accounts. Trading requires consistency. Your strategy only works over a series of trades, but fear breaks that consistency. You exit winners too early. You avoid valid trades. You interfere with your system. And when you interfere with your system, you destroy the statistical edge it depends on. Professional traders understand something beginners struggle to accept. Losses are part of the job. They are not a mistake. They are not a failure. They are simply the cost of participating in the market. Disciplined traders deal with fear by accepting risk before they enter the trade, not after. Before they place a trade, they already know how much they are willing to lose, where the stop loss is, what the trade idea is. Once the trade is placed, the decision has already been made. There is nothing left to negotiate with fear. Part 2. Greed. Greed is more dangerous than fear because greed doesn't feel like a problem. It feels like opportunity. Greed appears when traders start thinking about how much money they could make instead of focusing on executing their plan. You enter a trade with a clear target. The market reaches that target, but you don't close the trade. You start thinking, maybe it will go further. Maybe I can make even more. So you hold the trade, and suddenly the market reverses. What was once a profitable trade turns into a loss. Another form of greed appears when traders increase their position size after a few wins. They start thinking they've figured the market out. They feel unstoppable. So they risk more money than their strategy was designed for. One bad trade later, and the profits from several good trades disappear. Greed also pushes traders to overtrade. They see opportunities everywhere. They start forcing trades that don't meet their criteria because they want to stay in the market. They want action. They want profit now. But the market doesn't reward urgency. It rewards patience. Disciplined traders control greed by focusing on process rather than profit. Their goal is not to make as much money as possible on a single trade. Their goal is to execute their strategy exactly as designed. They follow their take profit levels. They maintain consistent risk. They accept that leaving some profit in the market is normal, because trading is not about capturing every move. It's about capturing repeat. Part 3. Overconfidence. Overconfidence usually arrives after success. You have a few winning trades, your account grows, and suddenly you start believing you've mastered the market. This is one of the most dangerous psychological phases in trading, because confidence slowly turns into carelessness. You stop analyzing as carefully as before. You start skipping parts of your process. You enter trades faster. You increase risk. And you stop respecting the possibility that the market can move against you. The market has a very effective way of correcting overconfidence. It humbles traders quickly. A series of unexpected losses can erase weeks of profits, not because the strategy stopped working, but because the trader stopped respecting it. Disciplined traders understand something important. Winning trades do not prove that you are right. They simply mean the market moved in your favor. A good trader does not measure success by how much money they made this week. They measure success by how well they followed their process. Because in trading, process determines long-term survival, not short-term profit. Part 4. Impatience. Impatience is one of the most common reasons traders lose money, and it usually starts with boredom. Markets spend a lot of time doing nothing. They move slowly, they consolidate, they form unclear structures. But beginners struggle with waiting. They feel like they must be in a trade. They sit in front of the chart thinking, there must be an opportunity here. So they start forcing trades. They interpret random movements as signals. They convince themselves that a setup exists, even when it doesn't. And once they enter the trade, the market does exactly what it usually does when there is no real opportunity. Nothing. Or worse, it moves against them. Disciplined traders understand that most of trading is waiting. They are comfortable doing nothing. They only trade when the market presents a clear opportunity that matches their plan. Sometimes that means taking only 1 or 2 trades in an entire day, or even skipping a day completely. Because patience protects capital, and capital is the trader's lifeline. Part 5. Revenge trading. Revenge trading is what happens when emotions take control after a loss. You take a trade, it loses. Maybe the loss was larger than expected. Maybe the market moved suddenly. Maybe you feel embarrassed. So instead of stepping away, you immediately try to win the money back. You enter another trade. But this trade is not based on analysis. It is based on frustration. You increase your position size. You abandon your rules. You start chasing the market. And very often the losses become bigger. This is how small drawdowns turn into blown accounts. Disciplined traders treat losses differently. They pause. They review the trade objectively. They ask 2 questions. Did I follow my plan? If yes, the loss is acceptable. If not, the mistake needs correction. But either way, the next trade is never placed while emotions are still active. Sometimes the best trade after a loss is no trade at all. The truth about trading psychology. Here is the uncomfortable truth many beginners eventually discover. Trading does not just test your strategy, it tests your personality. If you are impulsive, trading will expose it. If you are impatient, trading will punish it. If you struggle with discipline, trading will magnify it. This is why learning technical analysis alone is not enough. Many traders understand the charts perfectly, but they still lose money. Because knowledge without emotional control is useless in trading. The market does not reward intelligence. It rewards discipline. The mindset shift. If there is one mindset shift that can transform how you approach trading, it is this. Stop trying to win every trade. Start focusing on executing your process correctly. Winning trades and losing trades are both part of the same system. What matters is consistency. A disciplined trader measures success differently, not by today's profit, not by this week's results, but by one simple question. Did I follow my plan? If the answer is yes, the day was successful, even if the trade lost money. Because in trading, survival comes before profit, and the traders who survive long enough eventually become the traders who win. If you found this video helpful, then you're already thinking about trading the right way, because the biggest shift in trading happens when you stop chasing quick profits and start building discipline. If you're serious about becoming a better trader, subscribe to The Trading Jagaban, where we focus on the realities of trading that most people ignore. No hype, no shortcuts. Just honest lessons about how the market and your own mind really works. And remember this, the market is not your biggest opponent. Your mind is.